Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
When you hear the name Oshkosh, I am willing to bet a very specific image pops into your head.
Definitely like toddler clothing, right? The little striped denim overall.
Exactly, the ones with the little metal clasps. It's a funny misconception, really, because today's deep dive is into a company that operates in a completely different universe.
Yeah, we are definitely trading toddler apparel for heavy industrial machinery today.
We really are. We're looking at a $2.9 billion a quarter industrial powerhouse. I mean, they build massive mission-critical machines.
Bro, we're talking autonomous military vehicles, the massive aerial lifts that physically construct data centers, and the highly engineered fire trucks protecting your neighborhood.
So to really understand Oshkosh Corporation, and they trade under the ticker OSK, by the way, you have to look past the heavy metal.
Yeah, and the brand confusion, frankly. The real story here is the complex technology, the intricate global supply chains, and these long-term municipal and federal contracts holding it all together.
Right. And so our mission today is to unpack the mechanics of that operation. We want to figure out what actually drives the underlying business for you.
What their competitive moats are, and, the very real execution risks they're facing right now on the factory floor.
Exactly. And to do this, we are pulling from two primary sources. We have a brand new, highly detailed research report from Compasscope, dated today, actually, August 17th, 2026.
Right.
And we're combining that analysis with the company's recent Q2 2026 earnings call, which just happened a few weeks ago on July 28th.
So if we look at the structure of Oshkosh, the business is fundamentally divided into three distinct segments.
Right. Let's break those down.
So first you have the access segment, which is dominated by their JLG brand. This covers aerial work platforms, telehandlers, scissor lifts, and their ClearSky smart fleet software.
Okay, and then you have the vocational segment. I like to think of this as the civic infrastructure layer, right?
Yeah, that's a good way to put it.
You've got Pierce Fire and emergency vehicles, McNeilus refuse and recycling trucks, and AeroTech.
Right, AeroTech. They manufacture the specialized ground support equipment you see out on the tarmac at airports.
Yeah, like those little baggage carts and tugs. And the third pillar is the transport segment, which operates on this massive federal scale.
This is a huge one. This is where you find the United States Postal Service Next Generation Delivery Vehicle Program.
The NGDV.
Exactly. Alongside Oshkosh Defense, which builds tactical wheeled vehicles, like the FMTV A2 and that autonomous Rogue Fires platform.
Which is wild stuff. And, when you lay those three segments out, it might initially look like a disjointed portfolio,
right,
but there is a shared DNA running through all of it.
Oh, absolutely. What's fascinating here is that every single product is designed for a mission-critical vocational application.
Right. They don't touch consumer passenger cars at all.
Not at all. The value proposition here is safety, absolute reliability in extreme conditions, and decades of life cycle support.
And that life cycle aspect is so crucial. It's like the difference between buying a standard sedan off a dealership lot versus commissioning a customized mobile command center.
Right. A municipality doesn't just buy a Pierce fire truck.
No. They invest in a highly engineered platform that their emergency responders are going to rely on for like 20 years.
Exactly.
Yeah.
And because these machines are so bespoke, Oshkosh is completely insulated from traditional automakers. I mean, they aren't fighting Ford or Toyota.
So then who are they fighting against? Since the landscape is highly fragmented, I mean, who is their actual competition?
Well, it's specific to each segment. So in the access segment, they essentially operate in a global duopoly.
Okay.
Oshkosh's JLG brand goes head-to-head primarily with Terex, specifically their Genie brand. JLG holds a dominant 30 to 35% global market share.
Wow, 35% is huge.
Yeah, and they leverage their advanced safety and connectivity features to, maintain a really premium brand perception.
And what about over in the vocational space?
So there, Pierce is the undisputed benchmark for North American fire apparatus. They capture over 30% of the market. Their main rival is Orv Group. Now, Rev offers a wider variety of budget-conscious brands, but they've historically battled pretty severe margin volatility.
Which makes sense. So Oshkosh basically uses its sheer scale and massive balance sheet to invest in manufacturing upgrades that smaller players just can't match.
Exactly. And then in the transport segment, specifically defense, Oshkosh has carved out this highly specific niche in tactical wheeled mobility.
Right. They actively avoid entering bidding wars against the giant defense primes, right? Like General Dynamics or BAE systems.
Yeah, they do not want to fight over heavily armored tank contracts. They stick strictly to tactical logistics and wheeled mobility.
They know their lane.
They do. They recognize their operational strengths and just refuse to dilute their margins by trying to be everything to the Department of Defense.
Okay, but let's unpack this for a second, because the CompaScope report highlights a major vulnerability in that exact defense strategy.
The JLTV contract.
Yes. Oshkosh recently lost the recompete contract for the massive JLTV military program to AM General.
Yeah, that was a tough one.
I mean, losing a flagship multi-billion-dollar defense contract feels like a massive crack in their competitive moat, doesn't it? It suggests the government might just go with the lowest bidder.
Well, look, government contracting carries inherent single program risk, and losing the JLTV recompete absolutely stung.
Right.
But a lost bid doesn't necessarily mean the structural moat is shallow. Oshkosh's competitive advantage actually rests on two much deeper foundations.
Okay, what's the first one?
The first is the sheer friction of switching costs. Municipalities, giant rental fleets, militaries, they all heavily prioritize fleet standardization.
Oh, I see. Because of training and parts.
Exactly. If a city's mechanic bay is fully trained on Pierce fire trucks and their supply closets are just stocked with Pierce proprietary parts, moving to a different manufacturer is operationally painful.
And incredibly expensive, I'd imagine.
Totally. The friction to leave the Oshkosh ecosystem is immense.
That makes total sense. And the second foundation?
The second is their cross-segment technology strategy. So a niche refuse truck builder or a smaller defense contractor like AM General just doesn't possess the R&D budget or the diverse portfolio to cross-pollinate technology.
Oh, wow. So you're saying Oshkosh develops like autonomous driving capabilities for a military logistics vehicle.
Right.
And then they take that exact same underlying tech stack and deploy it into AeroTech airport baggage robots.
Yes. Or they integrate the safety sensor arrays into JLG construction lifts. It acts as an internal technology multiplier.
That is brilliant. It's an ultimate cook once, eat for a week strategy.
Yeah, they aren't siloed. The R&D spend in one segment directly subsidizes the technological advancement of the others. It allows them to just out-innovate smaller single-market competitors.
It's basically like building a proprietary operating system. You invest the heavy capital to build the core OS once, and then you just deploy it across entirely different hardware shells.
A fire truck, a postal van, a missile carrier.
Right. And because they can cross-pollinate this tech, they aren't just selling hardware anymore. They're unlocking completely new avenues for growth, specifically in recurring software and service revenue.
Exactly. When you integrate ClearSky Telematics or AI-driven predictive maintenance software into a fleet, you start monetizing the entire lifespan of those vehicles.
Which is a huge shift. So with that structural moat established, how does Oshkosh actually plan to expand its footprint and achieve its stated GDP plus growth target?
Well, that transition to a lifecycle service provider is central to it. But they also have massive physical growth levers they're pulling right now.
Like what?
In the access segment, demand is surging due to an influx of mega projects. We're talking multi-billion-dollar infrastructure investments, semiconductor fabrication plants, hyperscale data centers.
Right, because you cannot build a massive, sprawling data center without an army of JLG lifts operating on site for years at a time.
Exactly. The stickiness of those mega projects provides incredible revenue visibility.
And what about in the vocational segment?
In vocational, the growth lever is purely about physical manufacturing capacity. They are currently expanding their fire apparatus manufacturing footprint by 25 to 30%.
Just to chew through that historic backlog of orders for Pierce fire engines.
Yeah, the backlog is massive. And in transport, growth is entirely anchored to scaling up the USPS NGDV program. Those postal vans currently represent nearly half of the entire transport segment's revenue.
Wow, half. That's wild. And I know they're also actively rolling off old legacy fixed-price defense contracts that were dragging down margins, right?
Yeah, replacing them with newly negotiated better-priced awards.
Okay, but expanding capacity by 30% and executing a massive federal vehicle rollout, I mean, that sounds phenomenal on a boardroom whiteboard.
Oh, for sure.
But what are the very real execution risks on the factory floor? Because the CompaScope report flags the ongoing transformation of the Pierce fire truck manufacturing process as a huge risk.
It is the single most critical execution risk facing the company right now. They are moving a highly custom fire truck line from a static bay build where the vehicle sits in one spot and specialized teams swarm it to a continuous high-flow assembly line. And it sounds like a logistical nightmare.
Yeah, it sounds like trying to rebuild an airplane engine while you're currently flying the plane. You're dealing with thousands of custom, non-standardized parts.
Right. Setting up a high-flow line requires absolute perfection in material flow. Every single custom valve, hose, and chassis component has to be routed to the exact right station at the precise minute the vehicle arrives.
Wow. And if a single custom component is delayed?
The entire continuous line grinds to a halt. It's a highly delicate choreography.
Which is insane because you're trying to modernize a factory while simultaneously sprinting to meet massive customer backlogs. If that material flow bottlenecks, production slows to a crawl.
Exactly. But that isn't the only pressure point. In the access segment, they're fighting a constant grinding battle with price-cost dynamics and tariffs.
Oh, because their customers in this segment aren't small municipalities, right?
No, they are massive global equipment rental companies like United Rentals.
And those rental giants purchase in staggering volumes, granting them immense negotiating leverage.
So much leverage. When global steel prices spike or, new tariffs are introduced on imported components, Oshkosh cannot easily pass a sudden 10% price hike onto a customer ordering thousands of units.
So what do?
They have to engage in what the industry calls tariff engineering.
Okay, this is a fascinating mechanism because they aren't just eating the cost, right? They are actively reconfiguring their global supply chain on the fly.
Yeah, they will source components from different international jurisdictions just to bypass specific tariffs, or they'll slightly alter the physical design or assembly sequence of a part.
Just so it qualifies for a different, lower-taxed, harmonized tariff schedule code when it crosses customs.
Exactly. It requires extreme supply chain agility and intense cost discipline just to maintain price-cost neutrality in the face of giant, demanding clients.
So we have this picture of a company with an incredibly deep structural moat, brilliant cross-pollinating R&D, but they're currently juggling some very delicate manufacturing and supply chain transformation.
Very delicate.
And the rubber met the road on these exact dynamics during their Q2 2026 earnings report on July 28.
It really did.
Because the top-line numbers came in looking like a definitive win. Q2 sales hit $2.9 billion. That's up 6.7% compared to the same quarter last year.
Right, and transport segment sales specifically jumped 12%, driven almost entirely by the rapid rollout of those new postal vehicles.
But then, despite that impressive revenue growth, management dropped a twist. They actually lowered their full-year adjusted earnings per share EPS guidance down to $11.
Yeah, revenue goes up, but profit expectations go down.
Right. So why did that happen? That exact airplane engine rebuild risk at Pierce is biting them in the short term, isn't it?
That's exactly it. It points directly to a mix shift problem and the reality of that factory floor transformation to Pierce. Management was remarkably transparent on the call about it.
They were.
The material flow changes on that new high-flow fire truck assembly line are ramping up much slower than they originally modeled. The friction of routing those custom parts is bottlenecking the system.
Meaning they're going to produce and ship fewer fire trucks this year than expected.
And because Pierce fire trucks are highly customized premium vehicles, they carry some of the highest profit margins in the company's entire portfolio.
Ah, so shipping fewer of them creates a negative mix shift.
Right. You might be selling more lower-margin postal vans, which lifts overall revenue, but missing out on the high-margin fire truck sales severely impacts the bottom line.
Yeah, Matt Field, the CFO, quantified this directly on the call. He noted that the delayed pace of fire truck production is costing them roughly $1.50 per share in their expectations for the year.
Which hurts. But management was adamant that this is short-term operational pain required for long-term structural gain.
Right, because standardizing these modern process flows is the only mathematical way they can achieve the necessary throughput to hit their 2027 and 2028 financial targets.
Exactly. They are taking the margin hit right now to build a more resilient, higher capacity system capable of clearing that massive backlog.
And it wasn't all bad news on the call either. There were plenty of silver linings.
Oh, for sure. The broader health of the business remains incredibly robust.
Yeah, like the access segment brought in a massive $1.5 billion in orders. That's a 1.1 book-to-bill ratio.
Meaning they're taking in more orders than they are physically shipping out, which only builds that backlog higher.
Right. And John Pfeiffer, the CEO, specifically highlighted that the demand curve for mega projects is actually steepening.
Which led them to upgrade their full-year access segment revenue forecast compared to 2025.
And the vocational side also saw the McNeilus refuse business land, a highly lucrative, significant order with the New York City Sanitation Department.
That's a huge win. And over in transport, the rollout of the USPS next-generation delivery vehicles hit a major milestone. They surpassed 35 million miles driven on the road.
Wow. And the real-world feedback from postal carriers regarding the ergonomics and reliability has been overwhelmingly positive.
Yeah, and the actual delivery revenue for the program jumped 20% sequentially from Q1 to Q2.
Plus, defense proved they can still win outside of the JLTV program, right? They secured a $142 million order for the FMTV A2 and a $92 million order for the autonomous Rogue Fires platform.
And seeing the Rogue Fires platform secure funding is a perfect illustration of that shared autonomous R&D paying off. The technology they developed internally is actively winning federal dollars.
Okay, so if the fire truck manufacturing delay is actively depressing their margins right now and forcing a guidance cut, why is management so incredibly confident that Q4 and 2027 are going to be massive?
That confidence stems from Q4 shaping up to be this perfect storm, a convergence of major positive catalysts.
Okay, break that down for us.
First, management anticipates that the material flow friction on the Pierce line will finally untangle. That will allow the high-flow production rhythm to take hold and drive sequential margin improvement.
Okay, it's one.
Second, simultaneously, the USPS NGDV manufacturing ramp will hit full rate scale.
And when you run a massive assembly line at full capacity, you dramatically improve your fixed cost absorption rate.
Exactly. Spreading the overhead across a much larger number of vehicles instantly lifts margins.
Makes sense.
They're also modeling for another massive vehicle order from the USPS to drop in Q4. Securing that order provides the crucial revenue visibility needed to prime their global supply chains for the next several years.
And finally, Q4 marks the inflection point where those legacy, low-margin, fixed-price defense contracts finally roll off the books.
Right, allowing them to begin recognizing revenue from newer contracts that carry much more favorable pricing structures.
So you have production bottlenecks untangling in vocational, volume scaling rapidly in transport, and structural margins improving in defense, all coalescing at the end of the year.
It's a really powerful setup.
Synthesizing all of this, the compass scope analysis and the earnings call, if you are watching this company over the next 12 to 18 months, what exactly do you look for? Give us the ultimate checklist.
Okay, the most immediate variable on the checklist is Pierce execution. Achieving their stated 16 to 18% long-term margin target in the vocational segment is completely dependent on successfully completing that transition to high-flow production lines.
Right. If the material flow continues to bottleneck, it acts as a persistent drag on the entire company's profitability.
Exactly. The second variable is the execution of the NGDV program. The size and timing of that anticipated Q4 USPS order dictates the health of the transport segment.
And they have to prove they can sustain full-rate production scale on a brand-new vehicle platform without triggering costly warranty claims or quality control recalls.
Yeah, because those can devastate margins on federal contracts.
And the final variable on the checklist is the broader macroeconomic environment and its direct impact on municipal budgets. Because no matter how good the trucks are, if interest rates strangle megaprojects or municipal budgets dry up, cities won't be able to buy new fire or refuse trucks. The company has a massive backlog, but they are not immune to the cost of capital.
Right. When a city needs to purchase a fleet of $800,000 custom fire trucks, they typically issue municipal bonds to finance the purchase.
And if borrowing costs are sitting at 5%, issuing that debt becomes politically and fiscally painful.
Extremely. Municipalities will often choose to extend the lifespan of their aging current fleets rather than take on expensive new debt.
A tightening municipal credit market could quickly freeze new orders for Pierce and McNeilus, regardless of how badly a city needs new equipment.
Exactly. The backlog acts as a massive shock absorber for now, giving them incredible visibility into future revenue. But eventually, the gravitational pull of global borrowing costs impacts even the most insulated industrial sectors.
Absolutely. So, looking back at the journey we've taken today, we stripped away the brand misconceptions to find a remarkably complex industrial titan. We explored their dominance across the access, vocational, and transport segments, and how they're heavily protected by the brutal switching costs of fleet standardization and a shared, cross-pollinating tech stack.
Yeah, and we dug into the gritty reality of modernizing legacy manufacturing lines mid-stride, which is currently causing some short-term pain, but potentially setting the stage for a powerhouse convergence of catalysts at the end of the year.
It's a fascinating story.
It really is. And I'd leave you with this final, broader concept to mull over. We constantly hear endlessly about the software boom, the AI revolution, and the exponential expansion of hyperscale data centers.
Right. The narrative is usually focused on the ethereal, digital aspects of that growth.
But consider this.
Yeah.
Oshkosh is effectively building the necessary physical foundation for that entire boom.
Wow. Yeah.
Their access equipment is doing the heavy lifting, physically constructing the server farms and semiconductor plants. Simultaneously, they are sneaking autonomous AI-enabled robots into the fabric of everyday civic life, automating baggage handlers at local airports and deploying autonomous logistics vehicles onto military bases.
That is such a good point. You literally cannot host a server farm in the cloud without a physical aerial lift building the roof of the facility first.
Exactly. The true winners of the digital revolution might actually be the industrial companies building the heavy physical infrastructure that the digital world requires to exist.
It completely reframes how you look at a heavy machinery manufacturer. So thank you for joining us on this deep dive. Keep looking beneath the surface of the companies shaping the physical world around you. The next time someone mentions Oshkosh, you'll know there is a massive, highly engineered engine driving the business, completely separate from a pair of denim overalls.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.